pro futures trader with the futures, basic and fundamentals. One of the things that you're going to have to know or learn real quick is contract specifications. And every contract, we call them contracts, or every commodity has a contract specification. And what that means is whether that's crude oil, gold, silver, is they're all standardized specifications. So there's no negotiating going back and forth between buyers and sellers in the futures markets, which is very advantageous for people versus like in the precious metals markets. There's a lot of discrepancies that can happen because there's no specifications, there's no standardized specifications in the precious. I mean, there is to a degree, but not really in some of the other factors when you get to rare pneumatic stuff. And what that means is, let's do an example. So if I do micro silver, for instance, okay, and I do the micro, which is 1,000 ounces, okay, every person that buys the micro silver is going to be basically buying or selling 1,000 ounces of silver. There's no negotiating on that. That's what it is. There's even a 100-ounce contract and there's a 5,000-ounce contract. So you have your choice, okay? But it's standardized. So anybody that buys and sells the micro silver, it's 1,000 ounces for everybody in the game. And then what that means is for every dollar, okay, that the market goes up or down, you're either going to make or lose $1,000. Okay. And it's standardized with everybody. So you're either going to make or lose $1,000. Now you can put down what they call a performance bond, a down payment, but really it's a performance bond because you're not taking actual delivery in the micro. It's a cash settled product. Okay. On this particular contract. However, on the 5,000 ounce contract, you can actually take physical delivery. So cash settled means you don't take delivery. And then if you have a physically delivered that goes in the first notice and then delivery period, you can actually take physical delivery. But there's a lot of commodities, particularly in the micros and the minis, where it's just cash settled. So that's what that basically means. And the price quotation for every, like I said, the price is quoted. Let's say, for instance, the price of silver is at 80. Okay. If it's being quoted at $80 per ounce, what that means is you're controlling $80,000. Okay, $80,000 worth of product. Now, inversely, if you want to do the 100 ounce, so every dollar it goes up or down, it would be $100. Okay. Inversely, so if it's 100 ounces at $80, it'd be $8,000 worth of product. $8,000. Okay. What are the advantages of futures when it comes to the standardized process? Again, is there's no negotiating, there's no haggle. You know exactly what you're going to get when it's quoted against whatever price that you're being put on the screen right then and there. And what's mind-boggling to me is how many people go into the spot market where it's not as standardized. I mean, it is to a degree with some stuff, but it's not to another. So there's a lot of variables that can really work against you in the spot market, particularly when it comes to spreads and so forth. However, generally speaking, the spreads should relatively be pretty tight in the futures markets, but they can range, depending on liquidity, depending on time of day. But if you're in a really liquid market, you should have a relatively a good and a tight spread, reducing your trading costs significantly versus like a spot transaction where spreads can really widen quite a bit. However, in saying that, in the futures markets, if you do a very illiquid contract or you go really further out in time, your spreads can widen quite dramatically. So, the whole key is to stay where the liquidity is. But that is contract specifications. If you go to profuturestrader.com and you go to the bottom of the web page, you'll see contract specifications, market hours, and margins. Those are 3 pages. You're definitely going to want to bookmark and learn and figure out. Hope you learned something. Take care.